Hi guys, welcome back to Yashi. It officially started to happen. Something that we have been mentioning and forecasting for the past 2 years is probably starting to finally happen. In the past 2 years, the Federal Reserve have been fighting the inflation that we saw. Cost of living has been going sky high. You know, with rent, food and everything. I know all of you have been complaining because I've been, and I am also very frugal, but it has been a pain for a while. You know this exactly. So what are we talking about today? We've been talking something that many of the influencers have mentioned, both as a positive thing or a negative thing. We're talking about the Federal Reserve, which seems to be slowing down its pace, if not stopping it. So what did actually happen? Let's hit record here. Let's talk about it. Let's see what happened across all the other markets and specifically real estate, which is the main focus of my, let's say, YouTube account. Let's hit record right here. First of all, let's look at the news. In the past Federal Reserve update that happened at the beginning of November, Jerome Powell, the chairman of the Federal Reserve, decided to not raise interest rates. Of course, when asked about the future, he said that the future is uncertain. We could see interest rates hikes or not, etc., etc. So, of course, a lot of vagueness. Of course, he wants to be tranquil. He does not want to say that we're pivoting. He does not want to say we want to drop interest rates, or else everybody else would go euphoric. Money would flow back into the markets. Everything would go back up, and we're back into square one. The fact is that Federal Reserve did not raise interest rates. We saw this already in the past, but only after a small crisis, which was when SVB Bank failed. That's when the Federal Reserve stopped for a second to then continue hike. As per now, the Federal Reserve rate stays around 5.5%. That is the base rate of the Federal Reserve, on which then all other debt is then based. Mortgage rates are influenced by it, bonds are influenced by it, partially because then also they are influenced about the market and the insecurity or the security the banks have about the future. In this case, the banks were crapping the pants for the past couple of months, and this is why, on top of seeing the rate hikes that we saw until now, we saw mortgages go above 8% on a 30-year mortgage, which was crazy. It definitely had an influence over buyers who started to go back into the sidelines and wait for what would happen. The fact is, this move, the general sentiment that we could hear, the fact that we saw a lot of pain across markets, I believe that people are starting to think that we are at a point where at least we will see some stability in the near-term future. At least these are the expectations you can find online. You can see here linked to what people are expecting in the next couple of months in terms of interest rate hikes. But what has been happening now? After this decision of the Federal Reserve, if we now look at the current mortgage rate, in a matter of literally 1 week, we went from 8% 30-year mortgages to 7% interest rates on 30-year mortgages, even though interest rates from the Federal Reserve level didn't really move at all, which means that the markets are pricing in some stability, some stabilization. They're also pricing in the fact that Jerome Powell, during the update that we saw last time, also said that a soft landing right now is the most expected thing. He said it indirectly. He said that a hard landing is out of the books as per now, because we're seeing a large growth in GDP. We're seeing that Americans still have savings stacked up to pay for the higher bills right now. So although we were expecting much more pain, Americans are still sustaining all this. On top of this, we're seeing another key factor that Jerome Powell wants to see go higher, which is the unemployment rate. On the last jobs report, we actually saw how unemployment went to 3.9%, which means that we're seeing a little bit of an increase. We're also seeing more people flowing back into the job market, which will increase unemployment rate, participation rate, which means that people are running out of their money, they're coming back in. Why is this important? Because the more people we have flowing into the market, the more of the job demand by companies can be satisfied by people, and the less competition there is between companies to hire people, because now there's more people flowing in, which means potentially, this is the theory, of course between theory and praxis there's a lot of difference. This means that more competition among workers means lower increase of wages every single year, which means lower inflation because less money is in circulation. Anyway, 30-year mortgage, 7% interest rate, 15 is 7.1, and ARM is 6.75. I'm curious to see how many of these loans are out today, because I see an increase in usage of those, but I don't know the actual number. Anyway, let's look at inflation numbers, which also will have an impact on everything and also the conclusion of this video. PCE, which is the second report that comes out towards the end of the month, is at 3.4%, stable compared to August. Remember that the data is always from the month before. The last one we received was about September data, and it came out in October. So we're not seeing a lot of move in the inflation. And when it comes to the CPI, same thing, 4.1% on major categories. All items less food and energy in 3.7 again. So we are still almost twice as high compared to our target, which is 2%, which means that we're still trying to fight inflation. Did the Federal Reserve do everything that they could do? Well, there's still one, let's say, weapon in the pocket that they're working on, which is the quantitative tightening, taking away money from the market without touching the interest rates, which they said they will keep on doing and they will keep the same pace. We'll see if that will have an effect or not. Of course, there are many other factors, especially on food and gasoline, such as what is happening on an international level, the wars affecting international supply chains. How is all of this affecting the housing market? How could it potentially affect the housing market in the future? First thing we're going to say is that before the meeting of the Federal Reserve at the beginning of this month, many housing groups told the Fed to tell people that they will stop increasing interest rates, or at least that is expected from them in the future. Of course, the Federal Reserve did not respond to this. They said that there will always be the option of increasing interest rates in the future depending on inflation, etc. Why? Because if the Federal Reserve would say that they're going to stop increasing rates, the markets would go nuts. People will flow back into the market because it will mean that this is the worst we are in right now. If you buy a house now and refinance later, you'll be fine. Do it before everybody comes into the market. We're going to live another 2021 again where people are overbidding by 10-20% on the purchase prices. So of course the Federal Reserve needs to be cautious because on top of their policy, also the sentiment is very important. Remember that inflation is also a consequence partially from expectations of people. If people are expecting everything to be again good, they're gonna stop tightening their expenditures and come back into the market saying, who the hell cares? Stuff will be good anyway, so let's jump into it right now. So that's, I believe, what is happening. It's also a psychological game. So that did not happen. The Federal Reserve did not say they're gonna stop increasing interest rates. However, we can look at the market, what is happening now. In the past 2 years, the trend was pretty much the same. Buyers are getting out because houses are still expensive and interest rates are making it even worse to buy a house. The problem is also sellers, especially of pre-lived homes that already have been here for a while, already been lived in. People are not selling them because they cannot upgrade, because selling the current house to upgrade into something else means buying for something that is now more expensive with a higher interest rates. That's a double loss. You know what? Let me stay in my house. Let me wait in the sidelines. If the market gets better, if interest rates go down, I might sell then and then upgrade. So this is the current situation. If we look at, not days to close, but if we look at homes sold for that, home sold have been down, the lowest point compared to the past 2 years. If we look at the inventory, active listings, same thing. People are not selling. We are lower compared to the past 2 years. We're not at the lowest point that we saw in 2022, but we're still lower compared to the past 2 years. However, it is ticking up, which means that more supply is coming in. Is it enough to satisfy the demand? I don't know about that. The fact is we're still extremely low. Last but not least, let's look at how many new listings are being put in the market. In the past, the number is still extremely low compared to 2021. It is much lower. We're at the same levels of 2022, which were already between the lowest we've seen in the history of the United States. What does this mean? No homes coming on the market. Very few homes for sale. Demand is low, but still it is higher compared to the supply. So if you look at the price, median sale price, we are above 2022 levels. We're actually 3% above. So when everybody was saying we are hitting a crisis, not really. We're actually simply stably where the prices were until in the past 2 years. Nothing is moving. Interest rates are going up. So equity is still there. It is just getting more expensive to buy a house because of interest rates. Now, the fact is, this is data from October. Yes, exactly. From end of October, this is not calculating what happened in the past week with interest rates, which we know dropped by 1%. That is a more than 10% decrease in interest rates. Will it affect the market? I'm genuinely curious to see what is happening. We have the decrease in interest rates, which is also a consequence of what banks are feeling and the market is feeling. The question is, how will buyer respond? I believe that with the low supply that we have now, if people start to feel that this could be the worst point of all this status quo we saw in the past couple of months, more people could flood into the market. What does this mean? More demand, same supply. Home prices will probably go up. Will we see something like 2021? I believe that interest rates are still too high compared to 2021, so we won't see too many buyers, but I believe that the demand will start picking back up, which will keep home prices at least where they are. If they're going down, it will be by a little percentage, but I think that there's more possibility for them to go up. Of course, this is my opinion based on my experience, but I'm not a financial advisor, I'm not a real estate advisor, I'm just a realtor that uses his license to buy homes for himself as an investor. Guys, this is all for now. Always do your research. Let me know what you think. Let me know if you are already in real estate. Let me know if you're thinking about buying a house and what your feeling is. Because again, as I told you, half of the whole game is understanding how people are feeling, how open they are to jump in the market or not. This is all, guys. If you like what I'm doing, if you saw some value in what I did, please like and subscribe because many more videos as this one will come in. Thank you for watching. Ciao.